Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me today is Matt Noll, one of our senior portfolio managers. Matt, the 2024 election season is off and running as we had the Iowa caucuses last week. I thought our first video of the year we should talk a little bit about the election and its relationship to the markets.
Sure. Kind of first and foremost, the presidential elections are going to have an impact really based on the policies that the president makes. So in the near term, any policies could be detrimental to certain industries or they could benefit certain industries. In the example that policies might benefit an industry, you could see companies within that industry or sector create more profits, their stock prices are going to go up, so that starts to get priced in to the markets and you could see a little uplift in certain areas.
So we clearly know the last couple of presidents have had different policies and that truly has impacted at least parts of the market. When we think beyond policies, let's talk more a little bit about the near term and what we should be considering.
Sure. So elections tend to bring into markets a little bit of uncertainty, more so than normal. We all know markets don't like uncertainty, so when we start to look at where opportunities may exist, that uncertainty brings that volatility into play. That usually leads to that higher volatility in election years. But as this graphic shows, stocks tend to do very well in election years, and near-term market weakness could be a good opportunity to invest cash. There have been 23 elections since the S&P 500 was started. 19 of those 23 times markets were up in election years. On top of that, stocks were up 12% on average in election years where there's a first-term sitting president, as we have now, and they have been up in every one of those instances.
Ultimately, that tends to be good news. A lot of clients get nervous about the markets, but it tends to be positive at the year, regardless of what happens with the election. So we do know that volatility increases, particularly over the summer months pre the actual vote. So how do we think about working through that volatility or managing through that volatility with clients?
Sure. So one of the most important things, kind of long term, and we preach this to our clients, is remain invested, stay invested. You're going to have bouts of volatility. You'll have markets go up and down. Stick with your long-term plan, stay invested. So we've got another graphic here that shows political parties win. Which political party wins the presidential election has very little impact on long-term market returns. If you would only invest when a Democrat was president or only invest when a Republican was president, your long-term returns would suffer greatly versus staying invested regardless of who's the president. So even though volatility and emotions tend to spike during election years, the data shows that markets really don't care who's president over the longer term. The important thing, again, stay invested.
So that's straight talk, sound advice. It's something that's very First Source and how we serve our clients. If you enjoyed today's video, I encourage you to share that with your friends and family. And as always, thank you for the opportunity to serve you and your family, and have a great day.